Let's talk to Craig Erlam. He's a senior market analyst at OANDA. Very good morning to you, young Craig.
Good morning.
Right, so let's talk about a currency pair that we've chosen today, the sterling against the CAD. Is this quite a liquid pair?
I think it's liquid enough, and we've got to remember that you were talking about a market, the forex market, it's $4 trillion a day,
right.
Maybe even $5 trillion a day by now. I can't remember the last time I actually checked it. So, I mean, any currency pair, especially when you're talking about two currencies like the pound sterling and the Canadian dollar, are going to be plenty liquid. It's not one of your major currency pairs,
right.
But I sometimes think that's a bit overhyped. I don't think it's particularly important. It helps with liquidity, it helps with volume at times, but I think sometimes you've got to look at the less known pairs for a little bit of interest. And I think this is a great chart right now. I think we've even mentioned it in a previous video because not too long ago we had that head and shoulders forming between March and late April. And the signal that gave was quite a clear looking bearish signal, and since then it has actually materialised quite nicely, quite in line with the technicals. We had the break of the neckline, which also broke the 55.89 moving average cross and the rising trend line. So when you see a few indicators all coming together to form support at a level, when you see a break of that, it tends to be quite a significant signal, and on this occasion it was. We quickly hit the more conservative price projection, and important to note, with head and shoulders, they give you two possible price projections. One is the size of the move from the shoulder to the neckline, projected lower, and then there's the more aggressive one, which is the head to the neckline, projected lower. The shoulder took us to around 174.50. That was hit quite quickly. We saw a little consolidation after that, and then we've seen another sell-off since. The more aggressive price projection is 171. We've fallen short of that currently. Always nice when that coincides with another area of support. And we look at the chart right now, and you can see that 171 has been support in the past and resistance. That's great. It also coincides nicely with the 200 and 233-day simple moving averages, which are actually crossing each other pretty much at the moment, and they've been support and resistance in the past as well. So it's always nice when these levels line up, and I think once we hit 171, assuming we do, of course, then we're looking for the next signal. I would expect we may see some profit taking around that level, so don't be surprised if we see a bit of a corrective move. The interesting thing will come from whether we break 171, because that's another very bearish signal, but given the size of the sell-off we've seen so far, like I say, I'm not personally expecting to necessarily just bombard its way through there. And if we look at the momentum indicators at the bottom, they may give us signals as to what's going to happen here as well, because you can see that the most recent low was made on a higher low on the MACD histogram. That's the blue shaded area on the bottom oscillator. You can see that the moving averages on there are flattening out as well. The stochastic also made a higher low as well. That's called divergence. So that's not necessarily a buy signal in itself. It's a sign that momentum is slowing, which may suggest that we are seeing some profit taking kicking in already, and that maybe corrective move is following. That again doesn't mean we won't see another low in price action, and I wouldn't be surprised to see us hit 171. But again, if that comes again on lower momentum than we saw on the last low, then that would again suggest that it's going to take something significant for that 171 to break in the very near term.
So that's an absolute key chart point. In terms of mixing the technicals and the fundamentals, okay, is it right that basically the British pounds is weaker against the CAD short term?
I think fundamentally we look at the pound right now. I think they're in a way a little bit similar. Both central banks have been more hawkish for some time. The Canadian Central Bank actually raised interest rates twice last year and once in January. The markets have now pretty much almost fully priced in a rate hike at the meeting in July, and 50-50 for this month. They are also pricing in 2 rate hikes this year in total for the Canadian Central Bank. Markets are pricing in 1 for the UK. Both of them took a step back earlier on this year and noticed that the data was getting a little bit softer, so withdrew some of their hawkish commentary. I'd say the difference between the two, the primary difference between the two, is that sterling has additional levels of uncertainty because of Brexit and lower growth. Canada's on a slightly lower growth trajectory than it was, but things like the CPI data is improving organically, not because of Brexit, currency-related moves. The pound has the uncertainty associated with Brexit. Canadian dollar, in this case, may be getting lifted by oil moves. Canada's a big oil exporter, so you tend to see correlations between the currency and oil, and now we're hitting $80 a barrel of Brent crude. So potentially helping to support the Canadian dollar. I'd say the difference between the two is the Canadian central bank, I think, is likely to move quicker in raising interest rates than the pound. There may also be a short-term boost to the Canadian dollar should NAFTA negotiations progress as is expected, and they seem to be sounding more optimistic. So the fundamentals of certainly supporting the move here. I always personally look to the technicals to give me my signals and then see if the fundamentals support it. And in this case, that seems to be the case.
On that note, young Craig, thank you very much indeed.
Thank you.